This is Larry Shavaro of First Associates, and welcome to our 5th webinar in our Successful Alternative Lending Strategies webinar series. Today we have some really exciting content, case study on a recent securitization for ThunderRoad Financial, a power sports lender based in Nevada. And it was rated by Morningstar. We have Donal, Peter, and Phoebe who will chat with us today about the process and the rating structure for ThunderRoad. As in all of our previous webinars, they are on the First Associates website, including our last webinar, which was a case study for bank origination charters. We had Jill Gaddy from Cross River and Brian Korn from Manat, who talked about the recent Midland case and following up on some of the legislation there. Today's agenda will have a 8 to 10 minute presentation followed by questions. And so on the bottom of your screen on the left, you can chat with the presenter and chat with Rose, the chairperson, who will take your questions. We'll compile the questions, and we should have time for a handful, which Donal, Peter, and Phoebe will answer for us. Quick update about First Associates. First Associates is the leading third-party servicer in many asset classes today. We have about 160 people located in San Diego and in Baja. We have many institutional relationships with hedge funds as well as investment banks, and we're servicing over $9 billion in assets today. Whether it's a auto, power sports, marketplace lending, any type of loan except for mortgage and credit card, we provide primary, backup, custodial, and contract verification on all of these assets. Quick upcoming events that First Associates, and go back one slide, Rose, First Associates is going to participate in. Last night we hosted, co-hosted with our friends at Millennium Trust a wonderful meetup in San Diego. Please look for some upcoming announcements. There's many events coming up in June, the SCI Securitization event in New York City, and the Commercial Finance Association event the next morning, June 28th, and then the next morning, June 29th. Specialty Finance Conference, and a shout out to the American Banker Marketplace Lending Conference on September 28th, all four in New York City. Next slide, please. We're proud that ThunderRoad is one of our premier clients as well as many others, and ThunderRoad has graciously volunteered to talk about the securitization today. But you can see that our client base is pretty vast across many different asset classes as well as the investment banks. Next slide, please. It's my pleasure to introduce Donal Hummer. Donal is the President and CEO of ThunderRoad, and Donal is going to chat a little bit about the securitization process and a little bit about his company. They are a 2-year-old power sports lender based in Nevada, and which is pretty interesting about the topic today. How did a first-time issuer in business 2 years come out with a A- rating on his loan program? So I'm proud to introduce our client and my friend Donal Hummer.
Thank you, Larry. Good morning, good afternoon, everybody who's on the call webinar this morning. As Larry said, we're headquartered in Reno, Nevada. We're an indirect power sports company. We work closely with large finance and independent dealer networks throughout the United States. We provide prime and subprime financing to customers purchasing motorcycles, and then recently we just also added UTVs and ATVs to the spectrum of things that were power sports that we're lending against. As you said, we commenced operations in January of 2014, booked our first loan in March of 2014, and it's been off to the races since then. We currently have about 325 dealers signed up with us, and we are literally increasing that dealer count on a daily basis. We've achieved great growth over this last 2 years. Over this last year, our growth, portfolio growth increased almost 300%, and we're on track to have another big year in 2016. And we are planning to do a second securitization later, second quarter, third quarter of this year. Next slide. Some of the things that we had to consider, or if there's first-time issuers or people thinking about doing it out here, what you need to think about when you're going down the securitization route. I mean, for our standpoint, we have, over the last 2 years, we're able to get both a primary and secondary warehouse line, which gave us quite a bit of runway to grow our business. In addition, we were also able to do a handful of whole loan sales throughout the first 2 years. However, as we were starting to ramp up, we realized that we're going to need to go to a different type of capital structure to continue the growth and to allow us to get to the size that we want to. And obviously, there's a lot of ways to do that. One would be to get additional warehouse lines or bigger warehouse lines, go out to the equity markets, probably some combination of both. But in the end, what we wanted to do was something that I was familiar with one of my previous companies that I had been involved with, and that was securitization. From our standpoint, securitization is going to free up quite a bit of cash for us that we could redeploy. It was going to allow us to prudently grow our business, and that as if we were able to do the securitization right and get the right pricing that we needed to provide us a substantial gain on sale, which as a startup company or a new company, any gain on sale is obviously very helpful to the bottom line, plus you get a good residual stream out of the securitizations if you structure them right. However, we were a brand new company, so we kind of had to go down and evaluate the probability of having successful securitization. I mean, we don't have a large manufacturer backing us. We're not associated with a bank, and so we have to make sure that if we're going to go out to the market, that people are going to be interested in what we have to offer. And so some of the things that we considered that you would probably want to consider yourself if you were going down this route is what information is out there about your asset class. In our situation, there was a lot of historical information with regard to one particular domestic manufacturer securitization. Actually, I was involved with that company from inception and was involved with those securitizations when I was there. But that data really only dealt with that particular manufacturer's bikes. We have, our portfolio consists of domestic motorcycle manufacturers and both European and Japanese metric motorcycles, and there's actually very little data out there. So we were forced to go to different vendors and to different partners to compile that data so that we would have something that we could show what, how our portfolio would perform in relation to, say, the previous portfolios that have been out there just with a particular manufacturer. And so we had gotten that data together. In addition, we were able to pull together our performance data since now we were, entering into our third year. So we had a couple years worth of performance data, and so we said, okay, we have this. We think we've got enough there that we can show to people why this is a good investment. The other issue that you have to always worry about as a new issuer is they're going to look at the length of time in business. And once again, we were a short-term. We've only been in business a couple of years, but we were able to attenuate or reduce that concern of people because we have a very experienced team. This is actually the third powersports company that I've been involved with, a powersports finance company specific that I've been involved with since its inception. I was since 1992. So I have a lot of experience in this area. The team that I brought on board that did underwriting and compliance and originations, and we're all very experienced underwriters. I think the average tenure of our origination team was 10 years in powersports specific underwriting. So that helped us out there. And then the other piece is the experience of asset class. Once again, all of us had a lot of experience just in powersports. The third area that you kind of have to look at with regard to the success of a securitization is the servicing piece. You have probably three different modalities. One would be internal payment processing. second would be external, and third would be internal with some type of backup, either cold, hot, or warm servicer. In our situation, when people look at you and they say, well, what happens if ThunderRoad goes out of business tomorrow and we're doing internal payment processing, that's definitely seen as a risk. So early on, we decided when we started the company we were going to do something a little bit different, which because the previous companies had actually done internal payment processing. Well, we went with a third-party servicer, which in this situation was First Associates. So when people look at this and say, okay, what happens if? Well, if we close our doors tomorrow, somebody like First Associates, our servicer, would be able to process those payments, collect the payments, and make sure that all the bondholders were paid. And so when you put all those three things together, we have data about the asset class, we've got experience as an issuer in this type of asset, and we have in place a situation where no matter what happens to us, the payments can get processed and the bondholders can get paid. That is something that gives you a formula that I think, and actually as we saw, would be something that would be interesting for issuers. Purchasers. Anyhow, next slide, please. Part of the process you have to understand, it's a very, maybe a lot of people on this call understand this, but some of the inexperienced ones, this is a very engaging process. You have to find yourself an experienced bookrunner that is familiar with your asset or familiar with the asset class. Maybe it's not motorcycles, maybe it's auto loans or something like that. There's a lot of big players out there, J.P. Morgan, B of A, Mizuho, and then there's secondary players out there, Rabo, RBS, Jeffries, and then even some smaller players like Piper Jaffray. We actually went with a smaller player because with our previous relation with Piper, they were able to do things for us with regard to whole loan sales and secondary lines, warehouse lines, and so it was a good fit for us. A good bookrunner is very important to you because they will help you organize all that data for the investor's review, and they will help you go through everything that you have in your static pool analysis and get the stuff in the proper format so the buyers and investors can understand what you're doing. The other big piece of this is you need competent and experienced legal team. There's a lot of big players out there. We actually went with Sidley Austin, which was by far one of my best decisions. It's an expensive process, but it's a huge, complicated process, and you need someone that can help you through it. The offering memorandum is the easy part, but you have disclosures and warrants and opinion letters and structure and various intermediate corporate structures, bankruptcy remote entities, trust. The list goes on, and you need a group of people that can kind of encompass the whole process because you're going to have SEC questions, you're going to have corporate questions, you're going to have compliance questions, all those kind of things. At the end of the day, you want to know that when you put this offering out there, that it not only is correct, it's compliant, that it also has all the proper disclosures, and that I cannot stress enough. Also the same thing, they'll work with your bookrunner, they'll work with your accountants to do your pool selection and those kind of things. It's just very, very important. One of the things you have to realize that I didn't, or I forgot about because I hadn't done it in a while, is how much time it's going to take from your company. This is a very engaging process, and you have to make sure that they all work together. You just don't get to say, okay, lawyers, bookrunners, accountants, take care of it and get back to me when you're done. You have to stay engaged. You have to have your finance team engaged, your operations group, your reporting group, and you have to run your business. And so you just make sure you allow the time and the resource to do this because it is very encompassing while it goes on. Next slide, please. One of the things that we had to do that we had to look at is doing rated versus non-rated. 10 years ago, the question would have not come up because we were so young that we would have not even pursued a rating on this first transaction. Things have changed a little bit, and actually we had the situation where we were looking to launch a non-rated this transaction is a non-rated transaction at the end of 2015. With the Fed rates going up and a couple things turning against us, we decided to pull it and regroup. Obviously, January is kind of an ugly month, and so we didn't want to do anything then. So we looked to do this in March. Well, timing being what it was, I went to the ABS conference in Las Vegas, and if those of you who haven't been there, that's an invaluable place to go to. And we actually sat down with a bunch of capital groups and rating agencies. And while a couple of them said, yeah, we'd like to see 3 to 5 years of performance data before we do a rating, some of the others said, no, actually times are changing. And so we had some discussions with some of the rating agencies about potentially looking to do this. And I actually went to both rating agencies and said, well, I'm thinking my second transaction this year. And, the other one said, well, you're not the first one. And so when we went through those discussions, thought we could get it done, we signed a letter of engagement, set up the 17G 5 website, and we were off to the races. As you can tell from this presentation, we went with Morningstar on this one. And, that was actually a very good decision on our part. We actually had the previous, the securitization unrated sold, or we had offers out there or buyers for it, but we decided that it was worth our while to go non-rated, to go rated because of some of the things we could gain by doing so. It was a risk, but one that I thought was a good one. However, just because we are going to engage a rating agency doesn't mean either A, we're going to get a rating, or B, we're going to get a rating we like. You do put that at risk, but the same things that apply to that probability of getting a reasonable rating, but the same things that apply to even the success of having a securitization, and that dealt with asset class, issuer, and servicing, and all those same things apply. Basically, they went through the full process and everything I just talked about with us. The next slide, please. The benefits of a rating, if you're able to get a rating on the deal, is that it can lower your offering price substantially. In our case, it was a huge benefit to us. It also will increase the size of your potential investor pool. Many regulated insurance companies and financial institutions will not look or invest in an unrated securitization. The other items about this, there's a lot of intrinsic values that go with getting a rating. It actually, the capital markets start paying a lot more attention to you. It enabled us to actually get better terms in some of our current warehouse lines. It actually makes you a better company. Actually, the whole securitization process makes you a better company because, while we were doing things all right and we were very confident what we were doing, just the discipline and the process of going through a securitization, preparing the offering, and going through the rating and the audit to get a rating is a very good exercise to see how you really are doing as a company. I can't. I've dealt with a lot of rating agencies in the past, and I have to admit that this engagement with Morningstar was probably one of the best ones I've ever had. It was no easier than other ones that I've dealt with, but from the standpoint of putting people on this project, getting it done on time so that we could actually get the rating done and get the securitization out to the market and get it sold, I think from time to engagement to the time it was completed was something on the order of 30, 35 days, and that was tremendous. So for us to be able to do that as a young company, to get an investment rated bond rating on our first securitization was invaluable to us. And so, that's kind of the whole process. Next slide. So how did this all work for us? Well, it freed up $60 million for us to pay down our credit lines and to redeploy and grow the business. It helped out our bottom line. We didn't have to incur any new debt or equity. We've gotten better terms of our capital markets and from our credit providers, and we generate a lot of interest going forward, so that our next securitization will be bigger and better and priced better. And with that, I'll turn it over back to Larry.
And thanks, Donal. Thanks for the insight. That was really exciting information that you shared with us. And I know that we have, as I'm looking at the folks on the webinar today, we have many folks that would like to be first-time issuers as well, and so the information is very informative. Thank you for that. I'd like to turn it over to Peter Danna. Peter is the Director of Business Development on the Asset-Backed Security ABS side over at Morningstar. Peter, welcome.
Many thanks, Larry, and Donal. Thanks for the kind words. I can assure everybody we did not talk about this in advance, so that's a nice send-off. I'm Peter Danna, again, Business Development for the ABS Ratings team at Morningstar Credit Ratings. I'm here with my colleague, Phoebe Hsu. Phoebe is an SVP on the ABS Ratings team, and she served as a lead analyst on the ThunderRoad transaction. And as we go 2 slides forward. Thanks, Rose. So just as far as discussion points, as many folks are not familiar or may not be familiar with Morningstar Credit Ratings, I'm going to spend a few minutes talking about Morningstar Credit Ratings as well as our well-known or better-known parent, Morningstar Inc. I'm then going to provide some color on how Morningstar Credit Ratings, from our perspective, interacted and engaged with ThunderRoad. It was great hearing Don's perspective. And then I'm going to hand it off to Phoebe. She'll walk us through some high-level synopsis of the key components of the rating analysis. Next slide, please. Okay, so Morningstar Inc., it's one of the most recognizable and trusted names in the investment industry. The firm's committed to create great products and help investors reach their financial goals. That's their mission statement, and that passes through to Morningstar Credit Ratings. Morningstar Inc. is best known for its ratings of mutual funds, stocks, and ETFs, as well as the data it provides. It's also providing analytics and asset management services to millions of individual as well as professional investors. Firm has actually 4,000 employees now, looking at the March data. That data is 2015, December, spread across 27 countries. It truly is a global brand that they built up over the course of the past over 30 years. It's a great parent for Morningstar Credit Ratings, not only because of their legacy-free brand, but because of the excellent wealth of resources that they make available to Morningstar Credit Ratings. Next slide, please. Okay, some history on Morningstar Credit Ratings. I just circled 4 key dates. First and foremost is 2010. That's the date at which Morningstar Inc. stepped in and purchased the predecessor company, RealPoint. But I wanted to show also that there was a lot of history that goes back to actually 2001. Next most important date would be 2008 when RealPoint, the predecessor company, applied to the SEC and was granted the rating agency license, that NRSRO designation. They became a nationally recognized statistical rating organization. Another point that's critical is the fact that in 2009, RealPoint applied to the NAIC, National Association of Insurance Commissioners, and was granted the acceptable rating organization designation. That's critical in the world of structured finance, as insurance companies are key investors. They're key fixed income investors, institutional investors, and having that NAIC equivalency allows for a mapping of our ratings and other rating agencies' ratings into the NAIC scale, which is helpful. Again, Morningstar purchased RealPoint in 2010. Next slide, please. Okay, thanks, Rose. So since 2010, Morningstar Credit Ratings has approximately $165 billion in structured notes that carry Morningstar Credit Ratings rating. That's spread across from 250 transactions, which is a pretty respectable accomplishment over the past 5.5 years. Ratings are spread across a spectrum of asset types, with the bulk of it under commercial real estate, which should not be a surprise, as RealPoint was a firm that focused on commercial real estate. Apologies, there are a number of acronyms here, but just running through it. CMBS covers conduit agency, and SBSA, which is single borrower, single asset, which I used to refer to, or some people refer to as single property. You've got CRE lease, commercial real estate lease fee, as well as ground lease. And a single-family rental, where you have single borrowers as well as multiple borrowers. Side note on single-family rental, that's a case or an example of a scenario where we believe we define ourselves as a different kind of rating agency. Single-family rental was a scenario in which Morningstar Credit Rating was initially one of only a couple of agencies willing to dedicate the time and resources to focus on this new and unproven asset class. We were the first party to step up and release a published methodology, a rating methodology, and as a result, to date, we've rated every single transaction in that sector, and on a monthly basis, we are publishing a sector-wide performance report, which is very well received. Next, we have RMBS, which includes jumbo, NPL, which is non-performing loan, RPL, which is re-performing loan, et cetera. Then there are re-remics, and then ABS. ABS is, as people probably know, a spectrum, a wide spectrum of asset types. starting with anything in the A's such as aircraft and auto, moving out to motorcycles, moving out to utility receivables, and whole business securitizations. We at Morningstar are focused on ABS with a special focus on esoterics. Lastly, on those bullets I listed soon, we have an application into the SEC to have our corporate and financial institutions, our license expanded to include those too. Next slide, please. So as far as our involvement, Can we move to that next slide?
Give it just a moment. There's a little bit of a lag in the system.
Thanks, Rose. It showed up. Okay, so our initial discussions, again, Donal provided a pretty neat explanation of how we went through the process of engaging with rating agencies. From my side, I also just reached out to Don through LinkedIn. We sparked up a discussion, and next thing you know, we were talking about Morningstar Credit Ratings possibly providing ThunderRoad with what we refer to as an indication. Indications relate to transaction or an analysis of a hypothetical transaction, a hypothetical portfolio, and it's typically requested by an issuer or a banker or arranger that are just starting the process. We entered into an NDA. We were ready to start that process, and then we had that meeting that Don referred to at ABS Vegas, and we realized they were going to market with a different transaction. They were not going to get it rated. So this is the second case where I deem Morningstar Credit Ratings as a different type of rating agency in that we basically committed at that meeting to pull resources from different areas, and in an ultra-tight time frame, despite the challenges of a new issuer with limited data, we'll do our best to bring a rating to the table. And as you can see, this pre-sale excerpt on the right is evidence of that. That appeared a few days before closing. And as Don cited, the end result is a happier, better informed, more confident investor base, which as a result tightens the pricing and improves the execution for the issuer, something that benefits the issuer over the life of the transaction as there's a lower debt service. So with that, I'm going to transfer this over to Phoebe and let her walk you guys through the analysis.
Good afternoon and good morning, everyone. Thank you, Peter. Also, thanks to First Associates for inviting us for this webinar. Next slide, please, Rose. Yes, Morningstar assigned A- to the Class A note of ThunderRoad 2016-1. Besides the credit enhancement and legal structures, which I will cover shortly, the following three items highlight the transaction's strengths. First, the collateral consists of consumer receivables backed by motorcycles. As you all know, that motorcycles have years of history and they are well understood by the U.S. consumers. Second, the motorcycle has sizable and active secondary market, which is crucial to the transaction because the transaction relies on the realization of the residual value of the motorcycles when repossessing and liquidating those motorcycles becomes necessary upon the borrower's default. Third, ThunderRoad senior management has a track record of establishing companies such as Harley-Davidson Financials. Their previous success makes ThunderRoad a startup company with years of experience in the power sports financing. However, we also realize the transaction has a couple of weaknesses. As a startup company, ThunderRoad has limited performance history, and its managed portfolio is growing at a fast speed. This makes it a challenge for us to project the expected loss using its own limited performance data. And also, ThunderRoad portfolio has a higher percentage of subprime borrowers than the comparables. ThunderRoad defines subprime borrowers as those with the Vantage score of lower than 665. Next slide, please. Thank you, Rose. So to overcome the challenges, we not only analyze the collateral pool on the standalone basis, we also benchmark it against its comparables. We identify a series of transactions sponsored by Harley-Davidson Financial as comparables because Harley-Davidson Financial is the only ABS sponsor in the universe of the power sports financing. As you can see from table 1, that is the collateral comparison between the two sponsors. Overall, we find that ThunderRoad collateral pool is weaker to compare with Harley-Davidson because it has a higher percentage subprime borrowers, and also the credit score is lower. ThunderRoad use Vantage credit score, and Harley-Davidson use a FICO score, and we make judgment to make the two scores comparable in our analysis. We also use performance data from the series sponsored by Harley-Davidson Financial to supplement ThunderRoad historical data to project the expected loss. And lastly, the most important mitigant is to add more stress to our expected loss assumptions to address the multiple concerns I just mentioned. Next slide, please. Thanks, Rose. And this is a very simple structure of ThunderRoad 2016-1. The legal structure involves two steps of true sales, which is very common in the ABS consumer transactions. The transaction's capital structure is also very straightforward, which has the senior substructure with both Class A and Class B notes. Morningstar only rated Class A notes, and the credit enhancement of Class A notes composed of over-collateralization, subordination of Class B, excess spread, and reserve accounts. Each of the four components of the credit enhancement are very common in the consumer ABS transactions as well. Next slide, please. We conducted operational review with ThunderRoad Financial by having a face-to-face meeting with its senior management. Among other things, we talked about ThunderRoad business strategy, loan origination, underwriting, charge-off policy, residual value of the motorcycle vehicles, and the dealership relationships. We came to a conclusion that even though ThunderRoad is a young company, its previous experience of its senior management and core staff are portable to ThunderRoad's current underwriting and origination. First Associate Loan Servicing is the servicer of the transaction. We visited First Associate head office in San Diego end of March. We talked to First Associate senior management and core staff. Among other things, we covered its servicing platform, billing, collecting procedure, strategies of handle delinquent loans, policies of disposing and repossessing motorcycle vehicles. We believe First Associate has the staff, system, capability to serve the transactions effectively. And on top of that, ThunderRoad Financial is the issuer administrative servicer who monitors the servicing process on a regular basis. Next slide, please. Thank you. On the legal side, we rely on both external and internal attorneys to evaluate the soundness of the transaction's legal structure. We look at the issuer's bankruptcy remoteness. We assume that the issuer will have at least one independent director, and the issuer's business activities are limited to acquiring collateral and issuing securitization debt. We also analyze the legal opinions provided by the issuer's attorneys, including true sale opinions, non-consolidation opinions, tax opinions, and etc. We rely on the transaction's offering memorandum for representations, warranties, and enforcement mechanisms, and we benchmark them against our anticipation of similar transactions. We analyze them and disclose them in a separate report that was published when the transaction was announced. Next slide, please. With that, I concluded my session. I would like to hand it over to Larry. Thank you.
And thanks, Phoebe and Peter. And we appreciate all of the insight into the successful securitization rating. This is pretty interesting. We've gotten more questions today than we've ever received before, and I know that we're only going to have time to briefly answer a few, but what we'll do afterwards is we'll publish the questions, get them out to the panelists, have them provide responses, and then we will send out the answers to all of the questions to all of the registrants as well. One thing I want to make sure that I share with you, there is a survey at the end. If you would take a minute and please complete the survey, that helps us on future webinars as well. Here's the first question, and we've gotten about 4 or 5 of these type of questions, and so I'll start with Donal. Many folks feel that it may not make economic sense to securitize less than $100 million, and here this was a $60 million securitization. And so now that you've done the first, have you learned anything? What would you do differently on the second, and would you look at more than $100 million?
Well, your costs, that's a great question. Your costs are pretty, it doesn't really make a difference how large the securitization is. Your costs are going to be about the same. So clearly, if you can do a bigger securitization, you will reduce your costs for the transaction greatly. We're hoping in our next transaction to do one larger than this previous one for that very reason. Also, the good part about doing your second securitization versus your first is that you've already built the wheel, and so your cost per transaction will also go down just because of all that information and all the processes you put in place for the future securitizations. Some of the things I probably would have done different. Okay, go ahead. Yeah, that's good.
No, go ahead. Yep, thank you for that. And then part 2, yes, what would you have done differently?
Differently, I would have, first of all, I probably would have talked the rating agencies quicker, and because I think that was a process that I overlooked, and as a first-time issuer, made the wrong assumption there. So I would definitely do that. And then I would also allow myself a lot more time to get the first one done and be a little bit more realistic about that, because it takes a while for your first securitization.
Great, thank you. Here's a question for Phoebe, who is the senior analyst on the transaction, and as well as a 2-part. Why do you think it was reasonable to use the performance as Harley-Davidson's securitizations as a proxy for ThunderRoad? Is this a common approach, and how important was the senior management experience of ThunderRoad? How much did that rely on your rating?
Sure, that's a great question. I will break it down into 3 components. The first one is why we believe Harley-Davidson series are comparable. And first, I think this is a good practice in our ratings industry. And the reason why Harley-Davidson series are comparable because first, Harley-Davidson Financial is a big major player in the power sports financing sector. And second, the collateral pool from Harley-Davidson Financial and ThunderRoad Financial are both backed by motorcycle vehicles, the same asset, even though they may have different brand names. The third one is that we cannot ignore the fact that the senior executive of ThunderRoad Financial has successful experience in Harley-Davidson Financial, and we believe that is very valuable, and it is portable to the underwriting and origination process of ThunderRoad Financial. And to the question, how important is the ThunderRoad senior management to the transaction? To me, this is very important because as a startup company, it has very limited performance history, but I believe their senior management experience from its prior employer is portable in their business, especially underwriting and origination.
Okay. And with that, we are out of time. Many thanks today to Donal from ThunderRoad, Peter and Phoebe from Morningstar, and all of you that have attended the webinar. We will be sending the slides out sometime later today, and then we'll follow it up with a second email on the questions. Please look out for our next webinar, and have a great day.